perspective on the U.S. economy. We loosely titled this session Job Losses, Layoffs, What the Data Really Says. And for background, I'm Alex Randall Kittredge. I'm an HR people strategy operator, been chief of staff in a number of environments from public companies to private equity-backed organizations. And I'm here to give you a little bit of an inside scoop on the situation. So I'll kick it over to John to give a little bit of an intro.
Yeah, absolutely. So hold on one second here, Mr. Alex. Oh, sorry. I have our agenda here and I was in the wrong drive. Let me pop this up here. Okay. Here we go. Great. So hi everyone. So just by way of also mentioning, Alex and I became friends on Substack. Like I'm sure many of all of us are kind of becoming friends, and had some shared favorite books and kind of the academics in the economic space, and so we've written a couple different articles together. And yeah, and so today we were talking about what do we really want to do for the live and how do we want to focus it. And so we really wanted to focus on recent job loss numbers and layoff numbers, since we're all talking so much about that, and with the Challenger and Gray report that came out recently, and we want to kind of delve down into what these numbers are saying, or what we can kind of immediately tell they're saying about kind of the larger picture. One of the things I guess I would want to start with is that when people look at the total numbers of lost jobs this year, oftentimes the lost job counter, or the layoff number, the lost job, these numbers are sometimes discussed in aggregate, where we're looking at people who have been laid off for I think it's a period of over 4 months and continue to be laid off, versus those who were just laid off. And so it's kind of those who are continuously unemployed versus those who have just become unemployed. And the large numbers, the very large numbers, I think the number is like 1.1 million this year in total job losses so far. That number is in total people who have lost jobs and continue to have not found new work over this period of time. But that does not mean that people are not finding jobs, and that I believe this year we will, in the U.S. at least, we will still be a net positive in net positive job creation territory. I believe it'll be about 200,000 to 400,000 total jobs created. I also think that one of the sorry, I have a busy household here. I also think one of the critically important parts to look at when we're looking at this 1.1 million number that keeps getting talked about over this year is that this is also happening in a time when there was an extraordinary number of layoffs within the federal government. And where that is far and away the largest location where there have been job losses so far. I believe it's over 300,000. And I live in Washington D.C. So I've my wife lost her job as a contractor in February of this year, and has very fortunately found a great new job since. But I think it's kind of a big picture. We talk about, I think a lot of the numbers are talked about in terms of AI and what we're seeing with technology, but there's kind of this larger landscape out there. So anyhow, that's kind of a bunch of things. But what do you think, Alex?
I think too, with the Challenger report, it's important to note that they track layoff announcements. So
yes,
when you read the Wall Street Journal or you read Bloomberg and you see Target eliminated 18,000 jobs, that's what the executives have announced for Wall Street. So
yes,
will they actually eliminate all those jobs or not?
Right.
You have to look at the timing. You have to look at, is this coming around, the earnings announcement? Are we at the quarter close? Is this meant to juice the stock price as opposed to actually reduce the workforce? And I think there's a big difference there. You can say you can announce 18,000 cuts to jobs, but then maybe if you only eliminate 6,000 and you rely on attrition to eliminate the other roles, that isn't actually people being laid off. It's a little bit more of a natural process. So I think the headline numbers, when you read them in the newspaper or you hear them on the radio, they're almost designed to scare you or shock you, and in a way, you know, you know, give a boost to the share price on the stock market.
Sure. Yes. Absolutely. And I think there are a number of examples. Recently, I can think of one very large. Uh, uh, I think Amazon announced I think 14,000 plus layoffs, with I think another 16,000 coming in the months ahead. The week before their earnings report, and which from a corporate strategy standpoint and a shareholder value standpoint and a productivity standpoint. I mean, if you're Amazon or Walmart, and your value is the price that you can deliver for the customer, and the expediency of that delivery, then I think then sure, you have to look for those efficiencies. But one of the other things that I think, to your point, Alex, I think a lot of the conversation, like with the Challenger and Gray report, is speaking to publicly traded companies. These are announced. Those are the announcements that dominate the Wall Street Journal, the New York Times, the Chicago Tribune, to the extent that anyone's reading newspapers anymore. But those are the stories we hear those are the stories we see on CNBC, and we see on the television, and we people go into work the next day. Oh wow, lot of layoffs out here. That does not take into account the private sector, or the privately held business sector, and the small business sector, which of course is the primary driver of job creation in the United States. Now, I know, interestingly, when I used to watch these numbers, I had a distribution company in the manufacturing space, and so I would watch these numbers come out of Wall Street, and I was always thinking, as a supplier to a very large global public manufacturing companies, we were always saying, okay, what do these numbers portend about potential, what run rates are going to look like, and what production, what does this mean in terms of what they're anticipating in terms of their business over the next period of time. You'd look at various the ISM indexes and kind of those numbers. However, the employment numbers were always, okay, what is this going to mean about how much manufacturers are going to be producing moving forward? And so I think that's another part here is when you see these numbers, what does the kind of second level, what does it then say about what's to come, and what this is going to mean about how many toys parents are going to be buying for their kids at Christmas time, and and how many new cars are going to be purchased, and so on and so forth. Do you think about it in those terms too? I know you have direct investment firm experience, so I mean, I'm sure
Yeah, well, I think it's interesting. I know when I used to work in finance,
yeah,
listen, I always listen to Goldman Sachs, because Goldman Sachs has some of the best economists around. And
sure.
What they do, and their recommendation to some of their private clients, was to read the BLS reports. So, obviously it's not groundbreaking news. I think a lot of people do it, but when you think about it, that some of the top economists at some of the top banks in the country are diving into payroll numbers every month to understand where the economy is, because to your point, John, it filters down through all the organizations, through spending, through projected, demand. And I think what's interesting, I was reading a chart, I think it was from Bloomberg, that over the last 3 to 4 months, the majority of the small business hiring in the country has dried up. So the small businesses have sort of stopped hiring. You have these large companies that are still hiring, but to your point earlier, the majority of jobs in the country are created by small businesses. So what's that mean for the regular person who's out there, trying to find something?
Sure. And I think it's also, let's talk about the small business side of this, because I think that's, when I hear the conversation around small business, having spent my career really in small business, just to clarify too, for folks, when we're talking about small business, mid-sized business, big business, small business is zero in revenue to $250 million a year in revenue. Mid-sized business is $250 million to $500 million a year in revenue. And then you move on to larger businesses from there. If you're looking at it from how, a private equity firm might look at things, or kind of the larger marketplace looks at these things. So small business means, it doesn't just mean Main Street and kind of, that's what we talk about a lot. Small business. Oh, how's Main Street? Well, small business is the supplier base and infrastructure for big business. So you look at, if you go out to Washington and Seattle and surrounding areas, you see there's an extraordinary amount of employment that happens in those places because of all of the support businesses that are in place for Microsoft and Amazon. And so I think when we talk about small business and how it creates so many jobs this year, for instance, this year I believe small business in the United States, which is basically any company that is not publicly traded, is projected to create about 1.2 to 1.3 million jobs from what I've seen. So I think that's kind of a critical element for people to remember, that a majority of these companies are business to business companies supporting this kind of larger infrastructure. And to your point, there is a lag between when the larger companies cut and when the smaller businesses start cutting as well. Curiously, I think what we're seeing in the current situation is plenty of companies. I think Meta, Amazon, some of these larger technology firms. I think you're also kind of seeing with like JP Morgan Chase. There are job cuts happening, but these are also companies that are growing their revenue substantially. The Meta was really the first one I saw kind of do it a couple years ago, where they started significantly reducing their costs while exponentially growing their revenue, and so hugely increasing their profitability. And it's kind of like now Wall Street has gotten a taste of that, and so I think we're going to see quite a few companies push in that direction.
Well, you know what's interesting? I started my career in financial services, and I've written about this before. The firm I joined was Barclays Wealth America, and before Barclays, it was Lehman Brothers. And that goes back to 2008. And
of course,
folks that work in the financial industry are accustomed to these annual RIFs, reduction in force, layoffs.
Yes,
it's become sort of like table stakes since 2008, that every year a portion of the population, this was pioneered by McKinsey and Jack Welch at GE, that 10% of the workforce will get cut every year. And that is fine for finance. They've been doing it a lot longer than the rest of us. But I think what you saw in the aftermath of COVID in 2021, what I noticed at least, companies like Meta, companies like Google, these tech companies, almost, I hate to say graduated, but they started doing these layoffs that have since become sort of an annual thing. And I think up until that point, you really didn't see these large scale workforce reductions at the tech companies or outside of the finance industry as something that was almost standard operating procedure. And nowadays, it's much more normalized, or it's much more insidious throughout different sectors of the economy. Would you agree with that?
I do. I think kind of just two things. I think a number of the tech companies, if you look at the Magnificent Seven, I think a number of these firms, including Meta, I think Google, let's say it, Meta and Google, I think both of those companies, they matured. And so I think they had a price to earnings ratio and a valuation that was based on the innovation that they originally brought to the market. And I think all that got priced in, and the market being comfortable. Okay, their innovation has now become the standard, and we're now building on top of what they created. And so I think they realized, okay, we need to consolidate. We need to still look for what's next, but we also need to begin controlling our costs. I mean, I think that's the cycle. The innovator comes, they supplant the legacy firms that came before them. They are rewarded for that. Shareholders are rewarded for the success and the kind of the win of that innovation, and then they become the firmament, and then and so I think that's definitely part of it. But you mentioned COVID. I think COVID's interesting. Um,
Because I think, in my
yeah,
opinion, COVID sort of gave the justification for these large scale reductions in force. And
yes,
once it happened, right,
yeah,
and it's force majeure, it was outside of everyone's control.
yeah,
It almost showed companies that they could do it, or that it was possible. Companies that maybe never had done it or thought about it before. Would you say
yes,
that? I mean, I don't know in your business when you ran your business, but what
yes.
are your thoughts on that?
So this is a microcosm, right? But I was running a company during COVID. Um, we uh, we ultimately sold the company in August of 2021. Company had about 70. I think going into COVID, we had 68 employees going into COVID, and and part of what happened was this: in order to receive uh, the uh, the employee retention credits.
Hmm.
And I think it was really all tied to the employee retention credits. I think that was independent of the PPP program. Um, but that was essential for what the government did in that moment for us and many other business owners that I knew at the time. That was those loans and those programs were essential for the viability of plenty of firms at that time. We knew the business would come back. We knew the manufacturing sector would come back. The world stopped, and you had to get through it. And so we did not reduce headcount by one person through that period of time. That was what the government wanted, and I agree, because they had to keep people employed because so many people were losing their jobs. So many businesses were going out of business. So we did not reduce headcount by one person. However, I think we absolutely came out of that time enormously more efficient and clearer about who could do what and who had what skills that we didn't realize they had before, uh, and and so I don't think we were unique. I know we were not from talking to colleagues and things, but I wonder when I see what's going on now and the drives towards efficiency. I do wonder about the story that's going to get told 10 years from now about post-COVID, the efficiency. Airbnb is an incredible example on this with what they did during COVID to reinvent the business. And
Hmm.
Brian Chesky is like one of my heroes because in all sincerity, because of what he did with that company at that time. But I think there's a story to be told there and new efficiencies. And then I kind of wonder sometimes, are some of the layoffs and things we're seeing now residual from that period or from the learnings of that period. Anyway.
Yeah, no, that's a great point. I guess, switching gears, maybe,
Mhm,
talking about post COVID, talking about the current situation, talking about the
mhm,
lessons learned, the efficiency. Maybe we talk about the personal impact, or, what this means for folks in their careers, taking that macro and the data and really look at, if you're employed and you're worried about layoffs, what are some signs to look for inside your company, or that
yeah,
you
sure.
see in the market that might indicate
Sure.
there's some uncertainty at the executive level. So I
Sure.
think, certainly most folks are accustomed to the hiring freeze, no more new headcount, and just put a pause on things. We're
Yes.
good with what we have. A lot of times it also happens that the company decides to block backfills. So someone leaves and the role doesn't get replaced. So,
Right.
folks do more with less. I think that's something
Yes.
that anyone who's worked in finance knows about doing more with less.
Yes.
The magic of efficiency. And, you know, there's always that annual budget review. If whether your company does zero-based budgeting or incremental
Mhm,
budgeting, this time, it would have happened in September or October for this time of year, really
yes.
looking at reorganizing the organization, diagrams, looking at who
Yes.
reports to whom, maybe doing some matrixing, and that's
Sure.
that's become quite common.
Yep.
And if your leadership team stops talking about long-term bets and growth and starts talking about runway and efficiency, that can be one sign that things are not looking good for the bottom line.
Sure. Sure.